Most people think that commercial financing is one path. You find a lender, they approve you, you close. But there's a whole category of deals that don't fit that path. Good deals with good borrowers where the conventional structure has a gap that the bank can't fill. Today we're going to go through that full toolkit. What exactly works, when it applies, and when it goes sideways. I'm Ben Record.
Matt Russell.
And we are hosting the Advice from the Deal Room podcast. So Matt, when you hear the word creative financing, what do you think?
The first one that always pops in my head is seller financing.
Seller financing. So what is seller financing?
Seller financing is where the property seller is land, building, whatever it may be, is the one who actually is financing your deal because they're not requiring the full amount to be paid to them at closing. They are carrying a note for the remaining amount depending on what you put down.
So, for example, that could be they sell their property for $1 million and they have $250,000 debt that they need paid off. So you give them a down payment of $250,000, and that remaining $750,000 you would finance with them. Why would a seller want to do that?
A couple of reasons. You got some tax reasons why you want to do that. You'd also, if you had nothing else to reinvest those funds into, you might be looking at more residual income. Mm-hmm. Those are the two main reasons. Or they're selling it at a price that maybe can't get conventional financing, or the property is not ready for conventional financing.
So not ready for conventional financing. What would be some reasons why seller financing or these creative structures might be needed?
The property is probably underperforming.
Yep.
Not stabilized. It might need a lot of repairs.
Maybe mismanaged.
Yes, it might be vacant. It could be a vacant property.
Mm-hmm.
So typically you see a lot of land seller carry finance because it's not income producing and it's more difficult to get a loan, a conventional loan against just bare land. So typically bare land's quite a bit of seller financing that way. You also see it a lot in unstabilized or properties that need to have a lot of improvements done to the financials. So there's a big upswing for the buyer in doing so. Maybe a lot of repairs that need to be done as well. Or maybe it's less down. They can get away with less down, and the seller is looking to get out of that, managing that property themselves and have somebody else, and they're still making about the same amount of money because it was mismanaged, whatever it may be, and they got a little cat skin in the game. And their risk is the person quits paying, guess what? They own the property again.
Right. You got to repossess it.
Right.
You potentially got to take all that money you've already recouped.
Yeah. So they're sitting in a pretty decent spot from a protection back to them because they can take back that property. So it does help in risk mitigation.
The only risk there is when you're seller financing and you're the second and like the buyer's also getting additional financing.
Correct.
First position. Your protection there gets a little bit weaker, especially.
You very limited protection at that point.
Yeah. So other than seller financing, what are some of the other big buckets or that we see as creative financing?
It's still seller in a perspective you just kind of hit on one where there is maybe conventional financing up front, but you have a seller carry second. This could be a lot is done sometimes in business acquisitions, where maybe the seller will finance a portion of the blue sky, the goodwill of it, let you buy the real estate. If there's real estate involved, get financing that way, but maybe they'll carry the goodwill of the business. Maybe they'll carry inventory, equipment, whatever it may be to help get the deal done. So that's where we see it in there. And, with SBA, they allow seller carrybacks, but typically they need to be on full standby.
Right.
If that is what's required for your equity in. If you're trying to get your 10% equity into the deal and part of that 10% equity is a seller carried note, that needs to be on full standby for the life of the loan. But those are ways to help overcome obstacles for the buyer and helps the seller get what they ultimately want as the business sold. So, and they get to break up again some of those capital gains over multiple years if they do some seller carry portions. So there is wins around for people. Obviously there's risk with everything. So, that's just another form of seller carry financing that we look at.
So what's the biggest reason that seller financing or that type of structure with the SBA where you have a portion of it doesn't work? I feel like it's generally the cash flow is what's keeping that.
Correct. And that's why they usually want a full standby is the cash flow. For one, it's in the SOP. If it's part of your equity into the project, it needs to be on full standby over the life of the loan. Now, what happens in reality doesn't mean it's always on full standby.
Nope.
But then if it's not part of your equity, they have to consider those payments. So if it's not part of your 10% down in, it's just a little bit extra because it makes the lender feel comfortable. Sometimes the lenders like that because the seller, especially on a business acquisition, the seller has some skin in the game to make sure that transition for the new buyer goes smoothly, and they have a little bit more confidence in doing that deal.
Right.
Because if seller's not getting their full amount up front and they have to wait some years to get the remaining amount, obviously they have confidence in the buyer and they have confidence in that business to continue to perform at the levels that they're currently performing at to get the rest of their money.
Right. So with seller financing, everyone says, or we see online all the time, everyone's trying to push people to do it.
0% down, put no money down, get 100% seller financing. It works when it works and it doesn't work when it doesn't work. There is the problem about seller financing is typically you're not buying a strong performing property.
Right.
You could be. But
from time to time you are, but generally
you're buying something that maybe has an upswing to it, but most seller notes have a balloon to it. And when that balloon comes due, if the buyer of that property has not performed to the standards they thought they were going to be able to refinance and not have to pay any money out of pocket, because usually those deals where you're putting 0 to less than 20% down, so it's not conventional financing, that means there's an upswing to that property, right? So usually they're going to be interest only payments from the seller. Mm-hmm. You're going to have a balloon in 1 to 5 years typically, which means you need to now that buyer's got to be able to be proactive and get into that property and start managing it correctly to increase the financial performance of it, to increase the value and cash flow, so it can cash flow into conventional financing to pay off that seller.
Right.
Or they're going to have more money to bring to the table. So they put themselves at risk of not being able to pay off the seller because they don't have the cash in 1 to 5 years, or they don't have the property is not able to get the LTV or the cash flow and it's not appraising at the right amount because they did not do the work to get it where it needs to be. So there's risk associated with doing that.
Yeah, lots of risks.
Obviously we do lending for a living, but sometimes I recommend to clients, I'm like, if you get a seller created note, go for it. If the structure is proper for both parties. If I'm representing a buyer, I go, why don't you get seller financing on that? That makes more sense, especially when it comes to land. Number one, I'm like, if you get seller financing and you're not going to build, so your plan is to build, but it's going to take you a year to get to that, why not just get seller financing? Because you don't need to outlay all that money up front sometimes. That you're having that outlay.
Exactly. And it sets you up for that staggered approach.
Especially if purchasing the land is more than what you need to put down into the overall construction project.
Exactly, where the land has pretty significant value.
Cash is money. Sometimes I prefer people to hold on to as much cash as they can. So if they don't have to deploy that cash yet and they can wait a year, that's always beneficial to them too.
Yep. So we talked kind of about seller financing. I know there's lots of different structures for the seller financing.
Yep.
What are some other creative solutions that we have done or we've seen people do to help get deals across the finish line?
One I can think off the top of my head is going to be where we build with one lender and then we take it out to another lender. Sometimes, especially back in 2021, 22, when real estate values were not skyrocketed like they did, there was better cash flow, the rates were a little bit lower, strong net operating income, and material costs. I should go back to us. Material costs didn't go skyrocket quite yet.
Yeah.
They were around 22, but in 21, we could build with a private lender, so call it hard money or alternative lender, and then we're able to flip that over to a conventional lender later on, because let's say we build it for $1 million, but it appraises really it's a $1.5 million property because they're owner builder, and they're able to recapture their down payment that they had to put with the private money to recapture it. Now they're sitting into that property with zero into it, and they're able to move on, take that capital and move to the next project.
So what are we playing there? We're playing loan to cost versus loan to value generally.
Yeah,
right?
and we're playing what's the long-term plan of that client. If the client is looking to do more projects and recapture some of that equity and continue to move forward, and they have another investment for it, it is best to continue to move that path forward as long as it's financially sound decision to do that. So we've done that a few times where, plus they can move faster with private, so you're going to get a private loan done a lot faster, so it's speed to market. So you're also going to be earning money sooner. So we have, we'll run the cost analysis. What's better for the client and their overall, and everybody always looks at costs and fees, and I'm more worried about cash flow and cash on hand than your next project and equity you're building. Sometimes it's better to pay this to end up getting, I'll pay $10,000, get $100,000 out in cash flow. Even though that was an expense, I'm still getting cash to be able to reinvest somewhere else. And looking at those opportunities where some people go, I'm not paying that fee. You're like, but you're going to be able to turn this and get another property and keep going, and your overall cash flow is going to improve.
Well, and when you structure it that way in the fund math world, that's basically an infinite return. You don't have any more cash into the project, and now you're just making money.
There was one that we've done, and we bought it with private money. We renovated it with private money. And then once we got tenants in place, we took it out to conventional financing, and we recouped 100% of our equity,
right,
of our cash equity into the deal. So we were able to use that same method for my own personal property that I own. So that works well for us too. We also have clients that build out of cash, and then we take it back to financing later on, and we're able to recoup equity that way. So if they have the cash, I've told one client, I go, you have the cash, why are we getting a loan? It's going to cost you this. I can take you out here, build it in cash, and I'll do the refinance later.
Well, and you're saving the headaches that can come with going through construction draws and all that type of stuff too.
Yeah.
So when you have the cash,
the extra inspection fees, just the extra headache that comes with construction financing. So I look at that again, what's best for the client. I can give them another loan. Okay, great. But what's that do for them?
Well, and that goes back to one of the biggest things here at AI, and this whole podcast has been about trying to give advice first.
Correct.
Even if that means we don't get loans out of every single time that we give advice, we'd much rather educate and help people grow so that they can come back or refer us deals for more people that need help.
So another one that's on that similar line is sweat equity into a project. When you're looking at a project, they're a GC, or maybe they're an architect engineer in the project, and they're doing all the plans for it. What would they charge a third party for that? Well, they would charge, let's call it $300,000. Well, that is, if you did all yourself, that's the equity into the project.
Right.
If you're doing some of the, and usually this is prepaid equity, not equity further on in the project, but it's ways that what would it cost you if somebody else did that?
Right.
And look at it from that perspective, and let's put that into the budget. So we've been able to work in sweat equity into a project cost because it was a relevant cost that if somebody else was doing, they were going to have that expense related to that.
And sometimes they have earnouts and all that type of stuff on there too.
Well, that's we're not even getting into that one yet. So that's that. So there's other avenues that we've done. It's still conventional financing, but let's just say you have a property, you're buying it here, and you're going to get it to stabilization. And sometimes they'll loan here, but as you hit certain metrics, they will give you equity earnouts. So you, instead of having to redo another loan and refinance it, they kind of build it into the loan with standards and requirements to receive those additional funds. That is done one of ways, in the original loan, or sometimes they'll let you come back and do a second loan against the property.
And they do that because they understand that the property's value and your equity position is going to grow
and the cash flows there to support the debt, and they want to maintain that relationship in that loan instead of seeing it go somewhere else and go, well, you're not going to accommodate me, I'll just refinance it and go to the guy next door, right? And so building these structures, again, it's all about trying to understand the client's goals. Like, we're only going to build an equity earnout if they want that equity to be able to flip into the next project.
Right. Well, and that's what we do a lot of times, is figuring out what is the client's goal and then how do we cross the room or help them achieve that goal. And it's not always what they want initially or what they asked for.
What they asked for. It's not what they wanted, it's what they asked for.
It's what they get at the end of the day. It's what they need. So
another one similar, you're still, another one is refinancing some other assets to buy a new asset. Sometimes people forget, like, you got a lot of equity sitting up here, and it's not even refinancing. Sometimes it's recommending them to sell that asset because their return on equity in that property is not advantageous to them long term. I am working with a client right now, and we did a portfolio analysis for them and came in and go, man, based on this, your return on your equity in that building is less than 1%. Why are you doing this? Where's the gameplay? And then said, hey, you're looking at a few other properties. If you were to take that money and put it in these properties, here's your now new cash flow. Here's your improved cash flow. Here's you had the same equity because you dispose of this asset and put in this asset. So equity has not moved, but now you have greater cash flow, we got to look at the appreciation and the pay down the mortgage and look at the 3 different avenues to make money. And if you're hitting all those, it's better than what you're doing over here, then why not make that move? So we'll do that, or we say, hey, we need to refinance this. You're still going to, your overall cash flow. Sometimes it's not selling, because the problem about selling is you have selling costs. Mm-hmm. And if you're not 1031ing, you're going to have capital gains. Yep. So we always look at the refinance option first to see if that is something better that we can do for the client.
And that's where the advice first comes in, because we have to really understand what they're doing, why they're doing it, because advising them to sell a property and they're not going to go deploy the capital, it's like, well, that's not helpful either.
Or refinance it. I have some people, I'm like, let's not do that. Yeah, we can do it simultaneously as purchase and sell the property, because there's no sense of doing it now until you have something else that is going to go into it. It's just going to cost you.
And sometimes we have those clients that say, hey, I have a lot of equity, I want to refinance it. And we say, hey, let's not necessarily refinance it. Let's look at getting you a line of credit on that equity, so that then you can deploy it as you want.
Yes, you still have access to the equity and you can deploy it that way. The last good one I can think of is, and this is mainly in the multifamily sector world, but we've been able to do it in a few other asset classes as well, is interest only.
Yeah.
The benefits of interest only obviously improves cash flow and can improve leverage as well, because you have better cash flow. Not always improving leverage, because usually most of those loans are
pretty low loan to value.
Yeah. LTV constrained. So, 65%, maybe up to 70% LTV constrained. But if it's putting that principal, if the interest rate is call it 4%, which is not today, guys, let's call it 6%, but
unfortunately,
let's just call it, say it's 6%. If you can get a higher rate of return than 6%, why not go interest only? Because by paying on your mortgage and paying the principal down, all you're getting is a 6% rate of return on paying those principal payments. But if you can take that money and invest it at 8%, you're playing arbitrage with the bank's money and making a 2% spread. And 2% might not seem a lot, but if you go in history and look at 2% over a longer period of time, I even saw something the other day. If you go, what's my return is 6%, 7%, what's the big difference? 1%. The drastic cumulative compounding of that over years was a drastic number. You go, wow, that is a huge number, that if I just invested at 7 versus 6, I would have made this return. So when I'm saying 2%, it might not seem like
it's not a lot, but it's enough.
A lot. It depends on the size of the loan. It depends on everything. But in those instances, those lenders, and then us as well, we're writing that property to make sure that when your balloon payment comes, you're able to refinance that property. You don't want to have an interest-only property like we were mentioning earlier with the seller carry financing, and all of a sudden you can't get refinanced. We don't want to be in that same situation, and nor is the lender on those. That's a lot of Fannie, Freddie, CMBS, life insurance money, those things that provided the interest only, because that's just how the debt markets work out there. And so they want to make sure that can be taken out. So I know Fannie and Freddie, they model a property, because they have so much data. They model that property and determine based on how many years of IO they can give you based on the cash flow, the projected cash flow the next 10 years, and the projected value in 10 years. So this is called a 10-year note. And where if rates did a shock up, could you still get refinanced out and not have to bring cash to the table? That's how they determine how much cash, how many years of IO they can give you.
Makes sense. Makes sense. So what are some pitfalls when people think creative financing is their solution? Or seller financing? That's the biggest common one.
A lot of it is they think that's the magic solution. Like, oh, you got creative. Like, honestly, there's only so much creativity you can do in the lending world, because you still need money to make money. Obviously, some money. It doesn't have. You don't have to have this much. You can start somewhere and build up and build that and continue to rinse and repeat and be disciplined. But a lot of people think there's a magic solution. They're just going to get rich by doing these scenarios, and that's just not how the world works.
No, I always love when
if you're waiting for that, go play the Powerball. And like, if you think there's some creative solution, all of a sudden you're going to do these things and you're going to have so much money. Go play the Powerball. You probably got the same odds, if not better.
You got to put in the work. And I always love it when clients will call me, have you heard about any seller financing deals out there right now? And it's like, yeah, you can spend your whole time looking for just those deals.
And I know
you're going to miss a lot of really good deals.
Yeah, I know a lot of people that do. And you're like, the only concern too is there a reason that you're requiring seller financing? Is that because your financial position is not that strong?
Key.
Do you not look strong enough to a lender to be able to acquire that property?
And then why is the seller potentially only wanting to do seller financing?
Are you taking a bigger bite than you should be? Are you buying a property that's outside of your capabilities and your financial wherewithal to be able to handle that? And so those are some of the things that makes me fearful out there for people and go, why would you do that? Why would you don't, it's like me trying to, I'm going to go run a marathon tomorrow. I don't like to run. I don't have the ability to run a marathon tomorrow. It's going to take me years of training to do that. So in the sense of the real estate market and our investment market, it takes years to build up to those things. You don't just go, hey, I'm going to go buy a $10 million property. Have you owned any property before? No, but they're going to give me seller carry financing. I don't have to put any money down. I'm going to be great. 5 years, look at me. I'm going to be great. Call me in 5 years. And if it worked out for you, more power to you, but I just be cautious of why that is.
Right.
What, do you have the wherewithal to be able to handle that property?
And have you just taken the steps you need to grow incrementally through the process? We've seen the clients that have tried to bite off more than they can chew, and we've seen the ones that started with one deal, and then 9 years later, you've done 10 deals for them, and you just continue to see them grow and scale and take the little nut from the first deal and flip it into the next
continue
one.
on and
next. So let's kind of pull it all back. We talked a lot about seller financing. We sell on our website, and we say that we do creative financing. Really, I think how we think about it is, how do we cross the room? How do we figure out what the client wants, what is possible out there with lending options? Is there seller up structures that can come together? And we kind of try to figure out what's the solution.
Or was there lending options that people were not aware of? You know? Have you thought about doing this as individual loans or doing a portfolio loan? Have you thought about doing these other things? It's deep diving into understanding them, and that's where we get creative. Is going, hey, here's this. Our creativity goes from here to here. So how do we get from A to Z? Maybe it's not A straight to Z. It's a little curvy, but we'll get there. But that's where we get a little outside the box and try to think of creative ways to accomplish their goals.
Right. Any final thoughts?
No, I was just. Again, it comes back to run. If you have a question, you have a property you're looking at, you think you got a creative financing solution, run it by us.
Yeah.
I'm here to make sure you got the advice that you can do to be successful. And that's not always us just getting you a loan. It's just making you successful.
Yeah. And I have earned more clients' trust by telling them they shouldn't do a loan than I ever have by just making a loan.
Or saying the idea that they have works, go run with it.
Well, and then we've also told clients, hey, that idea you have isn't great. And you got to readjust expectations a little bit. And you got to do that too, because if you can't be honest with someone, then what's the point of the advice?
Yep.
So, to wrap us up, we've been getting a couple DMs, Matt.
I know. I saw them.
And a couple comments.
Thank
People
you.
have been engaging. We appreciate that.
Thank you for the DMs, guys.
We appreciate it.
It started as a slip of the tongue on I think our first one is like, I just DM us. I'm like, yeah, okay. People need to DM us. So, like us, follow us, DM us, guys. Share our content, guys. Please continue to follow advice from the deal room, guys.
Even just a couple of the comments we've gotten that have been like, hey, we like this. This was really good.
Oh.
That just helps us know that you guys are listening and that you guys, what stuff you guys want us to continue sharing with you.
Yes.
Thank you. This is Ben Record and Matt Russell with
Thank you,
Advice from
guys.
the Deal Room.
See you guys next time.